So Greg and William, you want to get started?
Yeah, we can go ahead and get started.
Yeah. Mhm.
Cool. And you all can see my screen?
Yeah, can see your
Yes,
screen.
ma'am.
Awesome. Well, welcome in everyone. As you know, we are GOB Network Arizona. For any of the future meetings, go ahead. You can snap that QR code or you can tap that same link you used to register. And you should be able to register for our next call, which is in February, the third Tuesday of the month. Just to introduce GOB Network for those of you that may not already be familiar with us, we are a group of local, national, and international investors who are mentoring and helping new investors with deal making, resources, anything that's needed in order to locate and secure an investment. We're helping them and we're also helping to improve returns. The purpose of our Arizona chapter is to mastermind with local investors, get together, secure investments, build relationships, and also help our local communities. And we're in this, we call it a mastermind because we are wanting to get rid of the competitive mindset because there's a lot of property out there. We want to join in and partner, and we can do this together because there's so much positivity and so much that we can do when we work in the numbers together. So this is about our local Arizona chapter. We're looking to connect with you. If there's any brokers on this call and you have properties, we would love for you to send them to us. And if you are a broker, drop your information in the chat and we'll reach out directly to you. Here is our sponsor, the founder of GOB Network himself, Jim Biggs. Jim has a lot of history. He's also former military. He's owned several assets. He's been a sponsor for a very long time. And he's one of our partners on an investment that we have in Dayton, another one just right outside of Houston, and a few other across the nation. One of the most recent one is in Louisiana. I'm Alicia Milton. I am a commercial real estate agent. I've been in the commercial real estate industry for over 25 years. I've managed a lot of product from retail, land, office, you name it, I've managed it. I am here because I've seen a lot of investments occur and I've seen different communities um, fail. And I want to be a part of helping to rebuild those communities that are struggling here in Arizona. So that is a little bit about me. I'm passing the mic off to Greg.
Yeah. Thanks, Alicia. And hello, everyone. I'm Greg McKinley. I'll be speaking to you guys tonight about the infinite banking concept, but I've been investing in real estate for a little over 4, maybe 5 or so years now, doing things from single family to wholesaling to mortgage note investing. Also, I invested in the Dayton apartment complex that the GOB network actually did as like a fund. So I'm invested in that as well. And I did raise some capital for a 26 unit in Tempe, Arizona. That one did not fully go through to purchase because it was just like a lot of things that happened with that. But I did raise about $100,000 for that. Well, my first raise and didn't know what I was doing. So yeah, that's just a little bit about me. Thanks. So yeah, I just invest and I'm just like everybody else, just trying to build some uh, different streams of income and being able to just pass that down and help other people as well and educate and just help out when I can, help the poor. I'd like to do stuff like that. I do ministry work as well sometimes. But yeah, that's a little bit about me. And now we'll pass it to Sir William of the Stevens.
Hello, everyone. I gotta skip it. Hello, everyone. I'm William Stevens. I'm a local investor in Phoenix, Arizona. I'm actually I have a few properties here in Phoenix locally, and some single family homes and multi-family properties. I'm looking to build my portfolio in commercial multifamily, hopefully. So I'm looking for a partnership. I'm looking for operators and just connecting with the community and try to see if we can find ways to invest for a future.
Okay.
So here's our schedule, and Greg, take it away.
All right. Thanks, Alicia. Let me go ahead and get my PowerPoint up and then I'll share my screen. Sorry, guys.
Do we have somebody else trying to get in? Please.
I don't see anyone.
Yeah.
You should be able to see them too, William,
Let me move this over here. That makes it a lot better.
as your
Okay.
co-host.
Screen 2 and share. Can everyone see my screen?
Yes.
Okay, great. Okay, so thank you guys for having me tonight as the guest speaker. I'm going to talk about unlocking investment potential using the infinite banking concept and real estate together. And then here's just my insurance license. I actually got my insurance license back in August of 2023 because I saw the power of using like insurance. First, it's very important to have insurance if you don't have that set up. So that's something to think about that just so your family can be protected in case something were to happen to you because none of us are promised tomorrow. So it's always good to have something set up just personally. But I saw the power of this when it came to real estate investing, just having you be your own bank. And a lot of people I know that actually use this concept, they really love it. And I was like, let me learn about that, get actually licensed, and then do it myself. So that's a little bit about me. And I'm licensed in Arizona, Wisconsin, and Texas, but it doesn't matter where you live. If you wanted to talk about this more, I can easily obtain like it's called um, a line of authority. I can also get a line of authority in that state as well, just so I can legally help you out with a policy there. And I had the next 3 pages. We have some definitions to go over, but I'm not going to go over each one. I don't want you guys to fall asleep on the call, but just some ones I feel are important to go over. And again, I do recommend it. I know some people are driving, so be careful and safe, but if you can, go ahead and take screenshots of certain slides or whatever ones that stand out to you, just so you can, if you can review them later. And if you have questions, you could always reach out to me about something you did not understand. But initially, what I'm going to cover is just a few different definitions before we go into a tabular printout, which means it just shows you like the different numbers and how that actually works. So base premium, in case you don't know what that means, pretty much the base premium is what you actually put into an insurance policy monthly. And that typically is allocated to the death benefit. So a lot of people are mostly familiar with like term insurance where it lasts 10, 20, 30 years and you pay monthly into that. And then you have like a certain amount, maybe like $100,000 of death benefit, $50,000, whatever that is for, as long as you pay your premiums, keep them active, then you have that base premium. So that's pretty much what that is, the base premium. Cash value. Now, when we are talking about a whole life policy, because again, in case you don't know the difference, a term policy stands for terminated because it terminates after a certain period of time. So most people, like through a W-2 job, you may get the insurance that the company has is a group policy, and it may be 10, 20, 30-year policy, or you may have one on yourself, 10, 20, 30-year policy, and it's a lot cheaper than a whole life insurance policy, but it expires if you outlive that policy. That's the only thing about that, and you can't use the cash value. So that's the downside of term insurance. And when it comes to whole life insurance, you do have, again, what's called the cash value, to where every time you put money into the insurance policy, if it's if the premiums are, I'm sorry, the policy is structured correctly, I'm trying to say, then you actually will be able to build cash value to actually use And you think of it as like a savings account to where instead of having money in a savings account and it's not really collecting any interest or dividends, you can switch that money over to a whole life insurance policy. And then as you put money into it, you have a death benefit. So if something would happen to you, your loved ones are taken care of. And then also you can actually use it while you're alive. You don't have to wait until you die to be able to use the policy. You can actually use it while you're living. And you build up cash value and dividends. So think of it as like if you were to buy a stock certificate for Coca-Cola, Disney, Apple, whatever company, and then each time the company profits, they typically will pay you a piece of that dividend of their profits. It goes into like the dividend. The same thing with insurance companies. Since you're a policy holder of that company, each time the company profits annually, they will pay you a dividend into your death benefit and your cash value. So each year you compound and you grow your death benefit and your cash value. So just keep that in mind. A modified endowment contract, or MEC for short, this is something that in certain situations it makes sense to trigger, but most cases it does not. And what this pretty much means is if you trigger the MEC or MEC, it just means that now your insurance policy becomes an investment vehicle, because a lot of people in the past, what they were doing is actually dumping a lot of money into their insurance policies just so they don't have to pay taxes or count that money as income. And then the government kind of found out about it. So, they always are looking at what everybody else is doing. And they came up with this called a modified endowment contract, to where you can only put a certain amount of extra cash into your policy. And then once you go over that amount, now it's triggered and it becomes an investment vehicle versus an insurance policy. So then now you owe taxes on all the money outside of what you put in. So if you put in, let's say, $5,000 and you put $10,000 to the policy, you owe taxes on $5,000. So again, this is something that we structure to make sure you don't trigger a MEC, and but you can still build cash value and use it without triggering that. Okay, and on this slide again, if you want to take a screenshot of this, you can. I'm not going to go over all of these definitions, but it's just paid up additions rider in the upper left. What that does, that allows you to actually put extra cash into a whole life policy and being able to supercharge that policy. So it's called a paid up additions rider, or PUA for short. That allows you to put extra money into your policy. So again, you don't trigger the MEC, and you can actually use your cash a lot quicker than waiting, because some policies, if it's not structured right, you may have to wait 1, 2, maybe 3 years before you actually can use the cash value in that policy. But when you structure correctly, you will have access to that cash typically day one, or it may take a week or so once everything is approved and settled. But you have access to it in that first year versus having to wait 1 or 2 years. But the paid up additions rider is, think of a rider as like an add-on to a policy, because there are lots of different types of riders. So you have your main policy, and you have what's called a rider, to where it just gives you additional coverage for a little bit of money versus trying to get 2 or 3 policies. So you can actually have a whole life policy, and then you can have what's called a term rider added onto it. So now you have the benefits of both a whole life and a term policy on that. I'm sorry, a whole life insurance policy and a term rider. So you have a 2-in-1 essentially. So kind of think of it that way. And then that term rider would fall off after that duration of 10, 20, 30 years, is just like a regular term would, but you would still have your whole life policy. And sorry, I forgot to silence my phone. Just do that. So just kind of keep that in mind. But again, all these other ones like policy rate and loan policy rate, I'll cover that during the presentation. And participating whole life is just what we're covering as far as an insurance product that provides a permanent death benefit and then guaranteed interest and dividends, which makes it like good for using a cash. So I'll just cover that for now. But again, you can take a screenshot if you want to. And if you have any other questions about any of these other terms, I can answer it for you. And yeah, I already covered this. I won't cover that. Okay, so again, just quick disclaimer. This information provided in the presentation is for educational purposes only and not financial advice. So just, again, this is just for entertainment purposes for right now. So again, I already explained this, but what is actually infinite banking, in case you never heard this concept? So infinite banking, or IBC for short, is again just a system where you actually would become your own banker by growing the cash value inside of your properly designed whole life policy, insurance policy. Then you borrow against it to fund whatever you want, whether it's real estate or you want to pay off some debt or buy, a car, house with. If you have enough cash in it, you structure it to where you actually can use the cash value to your benefit while you're living. And this concept was made popular by R. Nelson Nash. If you guys have never heard of him, here's a screenshot of his book. I do recommend reading it. Now, this book can be a little confusing to read if you've never read it before and if you've never heard of this concept. I remember buying this book a couple of years ago before I even knew anything about insurance or whole life, and it was very confusing to me. But now that I understand it more, you read it like, okay, now I understand this, because they kind of use more technical terms. But again, this is the book that kind of gives you that base foundation. And then if you read it, it's a pretty big book, but a thin book. So actually you can read it a couple of times. And then eventually, as you see something more and more, you start to understand it a little bit more. And once you educate yourself a little bit more, it just becomes a little clearer. So just keep that in mind. If you want to buy that book, you can get on Amazon or other places books are sold. Okay, so benefits of infinite banking. If you guys look at the top chart there where you see it says based on guaranteed assumptions. What that chart shows you is these are the guaranteed assumptions that your policy will grow into over time. So you have your guaranteed death benefit and your guaranteed cash value. So as you see, it goes up, and then typically when you are designing a whole life policy, the death benefit and the cash value will meet at a certain point. So these are the guarantees at the top. And this is just an example of, as you see, it's growing. Someone putting about 50 grand into a policy, and then, you see it growing a little over time. Now, the bottom chart represents the non-guaranteed, which these are the interest and the dividends that the company will pay you annually as they make money. Now, the companies that I use have been around for over 100 years. They've always paid dividends and interest, except one company one time that was during the Great Depression for 1 year. But other than that, they've always paid every year and always get paid out dividends and interest. So that's actually pretty confident to say that they will continue to do that when you get the assumptions added on, so you can see what your total values are. Now, this here is just a simple case study. What this chart shows is that this is just someone that is putting about $417 into their policy per month. Now you may think, wow, that's a lot of money for an insurance policy. I got a term policy for $50, $100, and this is like $400. But again, the way you're looking at this is you want to change your mindset on that. This is actually, you are becoming your own bank. And what you're doing with this is you're taking current cash that you already are using right now, and you're just redirecting it. So let's say, for example, after you pay all your bills every month, you have, again, $400 a month left over that you put into a savings account for like a rainy day or something. What you're doing is, instead of putting that into that savings account, you're just redirecting that $400 into a whole life policy, so then actually you can grow and build cash value over time. Also, another way you can use this is something that's called like debt-free life. And I won't get too much into that. I don't want to confuse you too much to where, let's say you're overpaying. Let's say you may have a mortgage, you may have a car payment, credit card debt, personal loans. You have a lot of different debts, 3, 4, 5 different pieces of debt. And let's say you want to get out of debt quicker, so you're actually putting extra money into your debts each month just so you can pay it off faster. And let's say, again, you're putting hypothetically $470 a month into that debt extra. So what you're doing is actually you're taking that money that you're putting in extra. Now, you still pay your minimum on your debts, but then you take the extra that you're using and you put that into a whole life policy. So then eventually, as you build the cash value, you would take the cash, pay off the debts, and then use your minimum payments you were using and put that back into your policy to replenish it. So eventually you can pay off all your debts and be your own bank, and you replenish your cash value in your account that way. But again, I can talk to you about that if that's something you want to talk about. But you want to use this vehicle to your advantage, because this is what banks do. This is what the Rockefellers did. A lot of the families in the early 1900s, in the industrial age. This is how a lot of people store wealth, and that they pass it down to legacy to their kids and their grandkids. But again, it takes a bit to wrap your head around this if this is your first time hearing about it. But at least you got exposure to it, and obviously I can talk to you about it a little bit more. But this is just a scenario. So now we want to do a little bit of audience participation. If anyone's in this, again, if you're driving, you could just listen in. But if you're sitting there, do a little bit of an audience participation. So what I want to show you is just a simple concept of how the cash grows in this policy. So what we're going to do is let's just start with year 10, right? Let's say you've been paying this policy, $417 a month, which equates to $5,004 a year that you're putting into your policy. But again, you're just redirecting funds you already have. And at year 10, you have put a total of $52,040 into your policy. That's what you put into the policy. And actually, let me do something real fast so you can kind of understand. So, okay, so you see the contract premium. So that first year, you say, well, it shows $7,000, but you say we're putting in $5,000 a year. So with this specific policy, how it's designed is the person, they had an extra $2,000 again, just they built up some money in their savings and they wanted to supercharge the account. They say, well, I have some money in my savings, but I see the benefit of doing this. So what I want to do is just supercharge my account with an initial $2,000, and then I'm paying that $417 a month because this is redirecting funds that they had. So that's why the first year you see $7,000 for the contract premium for the year, and then all the other years from there you'd be $5,000. So that's just a one-time payment, just kind of supercharge the account. So just kind of keep that in mind. That's what that is. And then you see here, so you see like the previous chart we went over, the guaranteed cash value plus the annual dividend that you would get from the company equals the total cash value over to the right. So you see from left to right, you see guaranteed cash value plus your annual dividend equals the total cash value. So remember the graph before, we had your guaranteed amounts and your assumptions. The left side of the chart shows your guaranteed cash value and death benefit. So that's if the company didn't make money that year, this is still guaranteed. But on the right is as they profit, they pass that on to you with dividends and interest. And then all the way to the left, the total cash value and the total death benefit will include your dividends and accumulated paid up additions rider. Hopefully that makes sense. And I can't see, I don't know if people are, and anytime anybody has questions, you can go ahead and ask. Let me actually do this. I'm gonna pop this.
So
I'm trying to pop.
no
Okay,
questions
yeah,
in the chat just yet, but
if you can
so
let me know, because I can't see like that. If there are any, I appreciate
that's
it.
fine. I have a question. So
Okay.
with the left side, I get the 5,004 plus 2,000. Then you
Okay.
go through the entire year, it looks like, or is that 10 months or 10 years?
Wait, say that one more time.
That's 10 years, right?
Oh yeah, the 52 down here.
Yeah.
Yes, that's after 10 years.
Okay. So that's 10 years of funds that you've put in to through the contract premium.
Yes, correct.
Okay. And then you move to down again and you went out 10 more years, which made it 20 years. And that's the
Yes.
contract amount right there, 102, right?
Yes, that's what you put in over 20 years. That's what you have put into uh the policy. Yes.
So each year you can't put in an extra 2,000. You can only put it in once.
It would have to be designed that way. So like if you remember, I know it's a lot of terms like the paid up additions rider, we would have to structure that to where, because there's a maximum of like extra funds you could put in a year. So like for example, let's say if you wanted to put $2,000 extra a year, we would just have to set that paid up additions rider as far as the maximum annual and see what that looks like. Hey, like maybe that would be what, $24,000. Let's say if you did that, oh no, like a year. So you would set that to like 2,000.
Right.
And now the good thing about the paid up additions rider is it's not something that you have to do. So you have your basic premium that you pay, and
Mm-hmm.
then your paid up additions rider, which will allow you to put that extra 2,000 in there. Yes, you can do that. We just will have to know that ahead of time, because once you structure it, you can't change a policy. If we know that ahead of time, then we will put that as a paid up additions rider to where you have the option to put an additional 2,000 in each year. And let's say one year, maybe you had hard times with your extra bills and you didn't have that extra 2,000, then you just will pay your base premium and not the paid up addition rider. But yes, you can structure to keep putting it in if you want to, just so you can maximize your account and the cash value.
Okay, so if you structure it that way, but you don't put it in, are there any penalties to that?
No, no, it's just that because that's just like like a benefit to where, hey, if I have the money this year, I could do it. If not, no big deal. You don't have to do it that year. Yeah, it's flexible. It was called a flexible paid up additions rider. That's what we would set it as. So it's
Okay.
flexible, and it's up to you to be able to add that.
Okay. And then on the right side where it says the total cash value,
Hmm.
when you said if the bare minimum of your investment, you're going to earn 125 approximately, well, 23 extra $1,000. So if you look at your total cash value, the second to the last column, your second highlight
Oh, over here?
down, right there.
Yes.
Okay. So that means that you're earning 23,000. Is that as long as the company does well?
Yeah, as long as they pay dividends. Because you see that year, for example, your dividend was $1,372. So that's the dividend they put into that for that year.
Mm-hmm.
If you look at it. So yeah, so long as the company, which again, all the companies use have been around for over 100 years and they've always paid dividends and interest. But yeah, as long as the company, they because the insurance companies they invest too into different real estate and other stuff. And as long as they get their return, then yeah, they share that out with the policyholder. So yeah, then they would add that as far as the total cash value will be, including what they're putting into your policy as well.
And so if they don't get a return, or let's just say the property goes bankrupt or whatever,
Hmm. All
does
it,
the insurance have insurance?
Yeah, so any insurance company that's ever went bankrupt, another insurance company always buys them, like always. There's never one company that just went bankrupt and it's just went to the oblivion. Another company always would buy them if that is the case, and then you just would get absorbed with that company, and then whatever you have here, they would pretty much keep your policy as you have, or if they have something better, they may offer you, hey, we actually have something we can do here, but they would just get absorbed by if a company were to go bankrupt, and then they would get bought out by the other company, and then now you still have an active policy.
Okay. So you can't lose more than what you put in.
Yeah, definitely. Yeah, you cannot lose more than what you put in. Nope.
Okay. Awesome. Thank you.
You're welcome. Good question. Those are good questions. Let's see. So then, okay, and then
I got a question.
yeah, yeah.
I want to look at the premium payment. Is it case by case the premium payment, or what's the qualification for the premium payment? Is it what they looked at to get you to the premium payment?
The qualifications.
Yeah.
I actually cover that at the end.
Okay.
So I do have a slide that shows that just because I try to make it as transparent as possible without anything hidden. Oh wait, I didn't know this was.
Mhm.
So I try to add everything. But I do have a slide actually, and if you want to take a screenshot of that, but I'll go over that because yeah, when it comes, so okay, I'll kind of answer like a piece of that. Good question though. So when it comes to structuring a policy like this, being able to qualify for a paid up additions rider, it does need to be medically underwritten because there's policies you get as non-medical as far as you don't
Mhm.
have to have a nurse come out, draw blood, urine, spit sample, all that stuff. This policy does require it to be medical to where you do have to have a medical exam in order to qualify for the paid up additions rider. Now, you still can get a policy that's similar to this. It just will be non-medical if you qualify for that, but you just can't have a paid. So it's not flexible to where you can put extra money into it. So like, for example, you put the 417, we still can design a policy that will be, $417 a month or whatever your budget allows, but you just can't put extra money into it if that makes sense. If it's non-medical.
Right.
But it
Okay.
still will build
Gotcha.
up and still pretty much do this. It's just like, for example, you might not have as much cash in like year one. It'll start accumulate more like year two or three, but because you can supercharge these medical accounts with the paid up additions rider, you can actually just have access to more cash quicker versus a non-medical, if that makes sense.
Right.
Okay.
Sounds good.
Okay. Any other questions right now? Those are good questions. Okay. So then the second piece is the same thing with just as like the contract premium and the dividend is when you look at your guaranteed. Can you guys see my mouse too? Like you can just see everything on the screen, right? You can see
Yes.
me kind of
Yes.
hovering over this. Okay. So the guaranteed death benefit here, plus like your accumulated paid up additions rider, what you put it in, then that equals the total death benefit. So as you can see, the cash value over time it grows, death benefit grows over time. Just to kind of give you a high level of how the, so you could understand the chart. Now, okay, actually, you know what? Okay, yeah, so now let's do this example again. If anybody wants to participate, I'll actually put this here. Can everybody see my calculator?
Yeah.
Okay, so again, if you guys want to participate too, I'm gonna ask a question and to see if you guys come up with the same number that I did. So I'm not gonna do it. I'm just gonna leave my calculator there. But let's look at because obviously investors like to know like numbers and like returns and how that looks. So again, let's just start with year 10. So again, as you can see, your total cash value, I'm sorry, yeah, your total cash value is 51,154. And this is obviously assuming that you are getting the dividends and interest from the company. So the total cash value, now subtract that from year 9 and let me know what you guys get. So you're going to subtract the total cash value here from year 9, which is here, $45,094. What do you guys get if you want to participate? Anybody? Okay. People are shy. I'll go ahead and do it.
No,
I'll
I
go ahead
was
and do it.
trying to see it, the numbers.
Oh, is it
Little-
really small?
Yes, really small.
Say that one more
Um,
time again, Greg.
actually, wait, how do you make this big? Wait, how do I
Like
don't
to
actually,
zoom in.
yeah, isn't there a zoom in icon
You could
somewhere?
just
Oh,
tell
wait.
us so the 10
Oh,
years,
oops.
52,000.
Is that bigger? Wait, is that bigger? Sorry, I know it's small. I'm gonna, okay, oh wait, that's probably a little,
Yeah, that's a lot better.
that's better. Okay, I'll leave it like that. So okay, so what we're doing is we see here 51,000. So we're starting with year 10 over here, and we're doing the total cash value here of 51,154, and you're gonna subtract year 9 of the total cash value. So what do you get there?
51, 154,
6,060.
60,
Yes. They said, yeah.
6,060.
Yeah, so if you look at it from that perspective, your gross profits of from year 9 to 10 is $6,060. That's like the gross profits. Now, what you want to do is to get your net profits, we're going to take what you put into the policy for that year and minus it from the gross. So like take the 6,060 and then so what did you put in that policy for year 10? Like year 9, 10, like it's the same every year. What are you putting in there yearly that you're paying?
5,004.
Exactly. Yep, 5,004. So you take 6,060 and minus 5,004, and what do you get? 6,060 minus 5,004. What do you get?
1056.
Yep. So your organic net profits for that year is $1,056. Now we want to look at what your return is. So you're going to take that 1,056 and divide it by your annual premium, which is 5,004. And what is your return?
21%.
21%. So again, look at that way to where I don't know if a bank, I mean, if you guys know a bank that pays you 21%, that I would love to know what that is for a savings account. But that's just the way to look at it to where again, if you just leave it in here, you don't take out policy loans or anything, your bank, 10 years, it took, it grew 21% in 10 years, which isn't bad. And then we're going to do let's just do one more year and then we'll move on to the next slide, which is year 20, just to kind of so you can kind of see the numbers because as time goes on, your bank grows bigger and bigger because it's compounding interest. So we're going to do year 20, which is the 102.80 here. And I'll kind of just say it just to kind of save time. But if you guys want to do it with me, so you could just want to help you kind of participate so you kind of understand a little bit more as you do it. So again, your total cash value is 125,643, which, wait, let me pull up my handy dandy calculator. So, okay. So I'll do it here for you guys. So 1,200,643, right? And you're gonna minus year 19, which is 116,986 equals again $8,656. So again, your gross profit from years 19 to 20 is 8,656, right? And then what we're going to do is subtract this from what you paid that year, which again is $5,004. So that minus 5,004 equals 3,653. So this is your net profits for that year. And then again, you divide that by 5,004, which is what you put in for that year. So 73% return on your money in 20, in 20 years, just on your infinite banking policy, to where you can also take up to 90% of the total cash value. So also when you look at here, year 20 here, you can see you put a total of $102,080, and your total cash value is $125,000, which shows you that now your cash value is more than what you actually put into the policy, which means that you're 90%. So let's just show you here. So what is that? So and you can take up to 90% of your cash value. So again, you could take out $113,000 and you put in $102,000. So you have more money that you can take out to use for whatever you need than what you put in. And that's just, it compounds and grows that way. And that's just just the basic policy, just to show you how that grows. And then I did another example of, let's say if you were blessed enough to have an extra $1,000 a month, right? And you were putting that, and you decided to switch that over to your own bank, and you put that into your policy. Obviously, your cash value, your death benefit will be a lot higher because you're putting in a lot more money. So I'll just read off the numbers here. So again, when you look at your, again, years 9 and 10, your gross profits is, $3,069. And then, oh no, I'm sorry, your what is it? Oh yeah, organic net profit is $3,069. And then if you were to divide that by the 12,000, because again, you're putting $1,000 in a year, which means 12 months in a year, you're putting 12 grand into this year, which means in year 10, you have a 25% return. And then years 20, you actually would have a 79% like return on investment if you can just let it grow, just sit there. And the good thing about the way whole life works is, so let's say, for example, you see let's just use year 10, $123,000. And again, you can use 90% of that, but let's just say you used 100 grand to do something, invest in real estate to get more returns. The good thing about whole life is that when you take out a policy loan, you're actually taking out a loan from the company's pool of money and not your policy. So what that means is this is a non-direct recognition, which means that your policy still grows at the 123,000 as if you never touched it. And they just use your cash value as collateral. So let's say, for example, if something were to happen to you, like you take out 100 grand, you buy property, and you end up dying from something. What the company would do is they would just subtract that policy loan that you have out from your death benefit, and then your beneficiary, instead of getting the 498 here, so your beneficiary would get almost 500 grand. They'll just subtract that 100K from there, so your beneficiary would get $398,000 versus the 4, because they'll just subtract it. So the good thing about whole life is, again, obviously it doesn't show up on your credit. you're taking out policy loans, so it's not taxable because you're technically taking out a loan, and you are in control of if, when, and how you ever pay back the money as far as the cash value. So technically, you don't even have to pay it back, but it is good to pay it back just because, again, if you use it as an infinite banking and you want to keep growing and be able to keep using it and replenish that money, it is good to pay back your policy loans, because obviously you get to a point to where if you tap out your cash, you don't have cash to take out, so now you can't take out a policy loan. But if you use it as like your own bank and that you are paying yourself back, you pay back those loans to yourself versus like a bank or an external source, and then you kind of keep that money within like your family and you build legacy that way. So just kind of keep that in mind for, if you want to
Greg,
kind of look at
I
it.
got a question.
Yeah, yeah.
Yeah, so how they structure the payback? You pay it back monthly, like just a the maximum amount, or it
It's up to
just
you. Like again, you are in control of
okay,
if, when, and how you pay it
okay.
back. If you want to do a $50 a month payback policy loan, that you can do that. If you want to do $100 a month, and then 6 months later you got some money, you say, okay, I can put 5 grand to that. It's
Okay,
totally up to
okay.
you. It's 100% flexible. You can put a $50 a month, $10 a month,
Wow,
$0 a month.
that's sweet.
That's up to you if you want how you want to do that. Yeah. Okay, so now I want to show you guys this because again, like I said, I want to be as transparent as possible and show you how all the numbers look. So because you are taking out a loan from the company, they do charge you interest. Now, the company I like to use, they have one of the lowest interest rates in the that I've ever seen from different companies, and they charge 4.5% as far as a yearly rate, and they have not changed their rate since 2001. So it is a variable interest rate, but again, they haven't upped their interest rate since 2001. But how it works is whatever the outstanding balance is, they would charge you 4.5% on that outstanding balance. So I just gave an example here. So again, let's say you took out a $50,000 loan, and again, 4.5% of that is 2250 in that first year. And we're assuming that, as you're investing in real estate or doing something to where you're getting paid and you want to pay back your policies, we're assuming that you're just paying 5 grand a year, back into the policy. So as you see here, each time you pay 5 grand here, now your remaining balance is 47,250 for the second year, and then now you're charged 4.5% on the 47,250, which means your total interest would be $2,126. And again, it goes down from there. You're paying 5 grand each year, and it knocks down your balance a little bit each year. So you're charged 4.5% of whatever that balance is for that year. And this is just assuming that you want to pay back your policy loan. So now this shows you the total cost of borrowing the money. So let's just assume that, again, you're doing an investment, it's a 5-year investment, you get all your money back in year 5, which means that out of those 5 years, and you pay back the full balance in year 5. It's just, again, you don't have to, but let's just say you want to. That means the total interest paid out of 5 years will be 10,964. So again, you can factor that into when you're looking at your numbers and returns. But yeah, you would have paid a total of 10,964 in interest. But again, technically, you don't even have to, like I said, pay this. This will just come out of your death benefit if you did not pay it. But this is if you wanted to pay back and kind of keep, level with your books. This is something you want to factor in when you look at like your total return and how, the cost of money and all that. But you do pay interest on the loans. You technically, yeah, you do pay interest on the loans. But just wanted to be transparent to show you guys what that looks like over 5 years at a 4.5% interest rate. If you borrow 50K and you pay back 50, now if you never pay back any of it, I mean, then you would pay obviously 2250 per year if you just kept this balance at 50 and you never paid down that balance. Then this would rack up. And then depending on if you didn't have enough, they may make you pay some back just based on like what you have in your policy, because you do have to have like a certain amount of like death benefit left. Because technically, it is an insurance policy, so you do need to still have enough to pay a beneficiary, so you can't deplete all of it. So they would cap you at a certain amount, and then depending on if you didn't pay this back, you kept racking it up. They may make you pay back a certain percentage. So just kind of keep that in mind. But we'll have to speak to the insurance company to see exactly what that will be if we were in that situation. Hopefully, that's not what people want to do, because again, once you pay that back, you replenish it, you can use it again for another investment, then pay it back, use it again for another investment. So I just want to show some basic numbers here when it goes again shows to like a savings account. As we can see, like average savings accounts are like less than 1%. Now, you do have some high yield savings accounts here at the top. I never heard of these banks here, like Tab Bank, UFB Bank, Bread Financial, but they pay like over 5%. So hey, if you guys these are resources, you can take a screenshot and go switch over your banks to those. But it just shows you again that banks pay roughly, 1, maybe 2% if you're lucky. I don't get 2% of my savings, but so it just shows you that it's a good idea to take money you just have there that you don't need today, put it into your whole life, and then you see the type of returns and interest you're getting on that. Also, again, a lot of people on the call, I know people are investors, so you probably are more familiar with this than the average person, but banks do what's called fractional reserve lending, to where you put $100 in, they can lend out $1,000, 10 times what you put in, and they are getting interest on all the money that you're putting in, and they're not paying you anything. So also, there's a lot of things happening with banks now, and sometimes people accounts are frozen, they can't get their money out. There's a lot of crazy things. You just never know. Everybody wanted to go to the bank at the same time and get their money, they'll be in big trouble. So something to think about there. Also, when it comes to a CD, a certificate of deposit, in the 80s, these were at 12%. That was great. And then now they're, 1 to 2%. I did hear some that may be like 2, 3%, going up a little bit, but I mean, that's a big dip over, 30 or so years, 40 years. But again, the CD, and it's not liquid. You can't really use the money, or you get penalized if you try to use it before it's done, or even after that, you have to pay taxes on that. It's not as liquid, and you can pay up to like 37% of income tax, on that. 401k over 20 years. Again, roughly, these are again the sources of Sophie.com. You can look at these sources between 5 and 8%, assuming the portfolio sticks to asset mix. But again, if you don't know, if you still work in a corporate job, a lot of people don't realize that the money managers in a 401k, they take about 60% of your gains over the lifetime of that fund. So I don't know if anybody on the call has ever known somebody that was able to fully retire just off of 401k, or you put all this money in there of all these years, and you're like, why does it look like it's really not growing that much? Like, the money managers take about 60% of your gains over the lifetime of that fund. And it's like, to me, that sounds criminal, because they don't show you all the fees. There's a lot of different fees that's hidden, that's not on like your statement. You have to really dig and ask, okay, what are these fees? And you see all these different fees, like, whoa. So, that's another thing to think about, where if you have just like a 401k that you're still putting money in, and they're eating up a lot of your returns. If you put, let's say, for example, you may have had, let's just say, like $1 million over, you collected all these 401ks over decades of working, and they take 60% of your gains. It's like, that's like $600,000 out of that, or something, that they're taking. If you would have gained like 1.6, you racked up all this money, or $100,000, they take 60,000 or something over like the gains. Whatever you gain, it's like 60%. So, and then a lot of 401ks dip. You see people work so hard decades, and then it dips. All their money's like gone. Now they can't retire. So you just think about that, to where there's better vehicles than what we're taught in society to put your money in. Okay, so I just wanted to give like this is a hypothetical situation. Just showing how, when you use your whole life insurance to invest in real estate. So obviously we see the returns it gets, just leaving your money there. Showed you the cost of interest if you were to take like 50K out, but not, let's see what that 50K would do on the real estate side. So this is just a hypothetical situation. This is a 50-unit apartment complex. Obviously, you can see the numbers here. It costs 12.5 million. Down payment was 30%. Mortgage is 8.75 million. It's a 30-year fixed, 2 years of interest only. Mortgage rate 7%. Expenses and all that. So this is just a hypothetical situation, just to kind of give you an idea. So, hey, if I do this, then an apartment deal comes up. Now I can, leverage that. So this is just, again, a hypothetical situation, to where, let's just say, the GPs found the general partners found a deal, and only thing you have to do is raise rents. Everything else is good, but the rents are on the market. You don't have to really do anything. So you automatically get a 10% cash on cash return each year. Your cash flow is $5,000 per year on $50,000. And then, assuming you're year 5, right, that they sell, you get your money back, and then now you can pay back the rest of that policy. But you're earning 10% on this deal. So that's $5,000 a year that you're earning. And then now let's just assume that this is a value add deal, to where you can increase rents, maybe at a dog park, some Amazon lockers, washer and dryer in the units, whatever it is, to where you can justify increasing rents that actually gave you a higher return. So in this example, you are accumulating $8,000 of cash flow again on your $50,000 investment. And so if you look at the right side of this graph, the accumulative cash flow, you see 8, 16, 24, 32, 40, just you're adding 8,000 each year to show you what your total cash flow is. And again, you put 50K in here, so that would be a 0.8% equity multiple, 80% return, which is, that's great compared to other investment vehicles. And what I like to look at here in this type of example, so let's just say, okay, wow, I'm paying the interest on that money, but technically you were able to invest in an apartment building essentially for quote unquote free. When I say free, obviously, you're putting your money into a life insurance vehicle, but the cash you're accumulating, you buy an apartment with it, then, invest in as an LP, let's say 50K, or that's your GP cut 50K. And then this is what you're getting each year. So now you usually could take that cash flow, if you want to pay back the interest on that investment, and then now you're technically not paying anything out of your own personal pocket because it's coming off from like the investments, like your insurance is going to the apartment is going back to the insurance. You see how that like kind of keeps that structure there, and then so you have like policies growing here, then your multifamily is growing here. Now you get the tax benefits, you get the everything from the investment, and you're technically not putting any additional money out of your pocket into the deal. It's just what you're using. You're just redirecting cash. So that's another way to look at it. You also get the depreciation, right? You may pay zero in taxes if you're a real estate professional, or you may have a W-2. You can still write off that against your income and pay less in taxes even with your W-2. So those are just some things to think about. So again, the risk mitigation and control. So using the cash to reduce dependency on external financing sources. You are minimizing your risk. With traditional loans, policyholders maintain control over their investments and finances. And again, it has that compounding interest component that showed you during those examples there. And now this one, I'm not going to spend a lot of time on it. Again, if you guys want to take a screenshot of this, because sometimes people ask, well, what is this between a whole life insurance policy and an index universal life policy? So again, there are differences and there are pros and cons to both. I personally still like whole life insurance over index universal life, even though there are times where you can get a higher return, but it can be more risky. So again, if you want to take it, I just put these here just for you to take a screenshot if you want to look at the two, or if you are familiar with this or not, I can talk to you about that as well. But we do offer these as well, like IULs. But it's a similar product, but they're different. So IULs versus a whole life insurance policy, just a different type of insurance policy that you can get. Here's another page of the pros and then cons of index universal life versus whole life insurance. So something that obviously takes a lot you to do some homework and be able to understand, but obviously you have people like insurance agents like me to be able to explain it to you a little more so you understand it and see which one is best for you and your needs, because not one product fits all. Some people prefer this or that or have more money to put in than that. So just structure it based on your needs. So it's something that is not a burden each month. Wait, I can't afford this. You always just want to look at as redirect funds you're already using into a whole life product, or even index universal life. And then, it's money you're already just storing up. So why not just redirect it to get better returns? So the next slide is for William's question. We asked what it takes to qualify for it. So again, this is to be able to get a paid up additions rider added onto your main policy to where you can actually put additional cash into your policy. It does need to be medically underwritten. So again, if you want to take a screenshot of this slide, it shows you these are just the things that when we go through underwriting, after we submit an application together, this is what the underwriters actually look at to see if you would pretty much pass or fail, get accepted or not for the policy. They do what's called an MIB check, Medical Information Bureau, to where they check electronic records, a pharmaceutical check, also like a urine analysis, some vitals, they draw blood. So again, just keep that in mind. Also, if you are in a dangerous occupation or recreation, like something to where it can cause death, like involving hazardous materials, explosives. If you skydive as a hobby or do motorized sports, then you won't qualify because that's too much of a risk when it comes to like insurance. Those people that's like famous. They have like $1 million insurance policies. The reason why they go with those special companies that actually would invest into them and risk that. But if you do like dangerous sports or occupation, then you probably won't qualify. All right, well, this is some other things I have access to. Again, if you do need just basic life insurance, maybe you thought about it, you don't even have a basic policy, you can talk to me about it. You can scan the QR code, leads you to my information there. I also do mortgage protection, universal, whole life, final expense, accidental death, debt-free life. Like I explained in the beginning, to where if you're already paying extra debts into something, just redirect that to a policy, use that to pay off the debt, then now you're your own bank. Annuities, if you have an old 401k that's sitting there just collecting dust, transfer that money to an annuity and you actually earn, better, and it's more secure. Uh, Mortgage acceleration, smart start, that's more for like kids. If you want to set up something for like your kids, maybe college, or maybe they want to become an entrepreneur and they have money to invest in their business, you can set something up like that. But yeah, these are things to offer. Scan the QR code if you want to contact me. Also, I have this QR code. So the one on the left, if you want to request a quote, just scan that, takes you to a Google Doc. You fill out the basic information. I run quotes, contact you, or the one on the right just has my email, phone number, or you just take a screenshot of this and you have my information there. But that's all that I have for you guys. So I really appreciate your time letting me present this concept to you. So yeah, if anybody has any questions, reach out to me, contact me, or we can open it up. It's the infinite banking concept.
That's awesome. Great. Thank you for sharing all of that information.
You are
That's great
welcome.
information.
Any questions? I know that we just lost Sonia.
Oh yeah, that's too much for me. I can't.
No, I think they may have one, her and her husband, but I think they have their own insurance. But it's good for her to know because she can share the opportunity with someone else.
Got it. You are welcome. Yeah. So, yeah, if anybody has questions, you guys now or reach out to me, and then
So I have a question. With the example that you showed, I saw
Mhm.
that 50,000 was put in, but only it looked like the investment was only earning 40,000. Is that correct?
That was just a hypothetical one. Yeah, but I just put it as because I was thinking that okay, if you're earning cash flow of 5,000 a year, then year five you get your $50,000 back. That was a 80% uh, equity multiple. So like you earn 40,000.
Gotcha.
So I
Gotcha.
mean, total you got $90,000 back. 50 plus your
Yes.
40, so
Thank you.
80% equity multiple.
I just wanted to make sure because I didn't see that on there, and I'm like, okay, wait, I'm trying to do the calculations.
Oh,
So that
sorry, yeah,
makes more
probably.
sense. That's okay. That makes more
Yeah,
sense.
yeah. I don't think I did. I don't think I showed total. I just showed it's 80%. Like you put 50 in, you got 40 back
I guess it's
plus your
because of the
fees.
interest, right?
What do you say?
It's because of the interest.
Yeah, like the return. Yeah, you got
Okay.
Yeah. So you get your return. I mean, you get your funds back, but I guess it would be considered capital gains.
Right.
Okay.
It's a nice concept, man.
It
I think I'm
is.
gonna get involved in it.
Yeah, I mean that's what a lot of the wealthier families they do to kind of keep that. Like R. Nelson Nash, the one who wrote the book, the Infinite Banking book.
Mhm.
I think he died with like $1 million loan out, like that he never paid back. But because his family has so many policies, that didn't phase them because they just took it from the death benefit. But what they did was like, because since he was doing this for decades, as his kids have kids, they would get policies right away on like their infants. And then as they get older, they teach them the concept. So when they want to buy a car or something, they never have to use the bank. They never went to the bank for anything. They just went to their policies. Okay, I need to buy a car. I'm just buy this in cash and just pay back myself as if, I went to the bank to get a loan for the car, or I need a house. They literally bought a house in cash, or the down payment. I think they might have bought the house fully because they had enough money to literally buy it in cash, and they just paid back. Like the grandpa would loan the grandkids money, and then now the granddad is the kid's bank, and they just paid that back to granddad. So, but yeah, it's just crazy how they kept all that in their family, so they never had to go to the bank for any loans for anything. They just used the cash in their whole life policies.
So that 4.5% that you mentioned, is that just a standard 4.5% loan
But it
on your
can
money, or
change.
does it
This
change?
is variables. He said it's
It's a
variables.
variable interest rate, but it hasn't changed since 2001. But it is variable, so you do keep that in mind that it can change. Other companies they charge Like some charge like 7.5% and
Wait,
6%.
when you say variable,
It can change.
it got it.
It can change anytime.
So that interest rate can change from year to year, but once you borrow it, it's not at a fixed rate. Like whatever the rate is for that year.
You can, I believe, now that's something I would need to look into, but I do believe you can request to have it like a fixed loan, but technically, no, it's not fixed. It would be whatever that year is. So, like, if, the longer you have that loan out, let's say the next year it may go to 5%, now you're going to pay 5% on that money, or if it goes to 5.5%. But I know for the company I use, Forsters, they're one of the lowest ones, and they haven't changed their or rates since 2001. But I know other companies have been changing their rates lately. Like again, some are at 7.5. Like another carrier I have, if somebody wants to take out a policy loan, it's 7.5% that they have to pay. But that's one of the lowest ones. But yeah, it is variable, so you do keep that in mind. That's why I do recommend paying it back as soon as possible, just so you can replenish it. You don't have to pay as much interest, and you just pay it back, keep it in there and then just rinse and repeat when you want to buy other stuff.
Cool.
Yeah, I did a class in infinite banking with Renaissance. You remember Renaissance? That's It's a guru company that I don't know if you guys remember that. Renatus. I'm sorry, that's Renaissance.
Oh, Renatus.
Renatus.
Oh,
Yeah.
okay. Yeah, I know
I
Renatus.
did
Yeah, I
that
know
infinite.
Renatus.
Yeah, I did real estate note with them too. Yeah, but I found out that this company, they're not really legit. You know what I mean? So I didn't continue with them. But I heard about infinite banking before, so
Hmm.
in there.
Yeah,
It's a
Renatus
good
is more of like some people describe it as kind of like in a sense, multi-level marketing for real estate.
Right.
Yeah.
I mean, I know a guy that's really successful. Like he is part of that company. He's really successful, but I don't know how the ins and outs or how the fees are, or when you pay for certain things. Like I don't know how that works, but I know, yeah, you do have to pay like one of those big chunks, like 10, 20,
Yeah.
$30,000 to get
Mhm.
into the program. But I mean, some people are successful, I guess, but yeah, I don't know how the technicalities of that.
Awesome. Are there any other questions?
You have any question, Chase?
Hmm.
I guess you mute.
Nope, I'm good, brother. I appreciate all the info, Greg.
Let's
I'm
go
gonna have
coffee
to
one day, man.
I'm gonna have to dig a little deeper with you when I see you in person, brother.
All righty,
Let's
let's
do
do
coffee one day, Chase.
it.
What was that? I missed that. What'd you say, Will?
Let's do coffee one day, man.
Let's do it, man. You let me know what day. I'm down.
All right, man.
All right, guys. I sure appreciate it.
Thank
No
you.
problem.
Kay, do you have any questions?
I'm good for now, but I probably would like to have his contact. I do have whole life policy, but I haven't do anything with it, so I just draw money out from my account every month from business account actually. So
Oh,
yeah, I definitely want to talk to him about that, how to make it work with real estate.
Awesome.
okay. Did you get a chance to get my information, Kay? I know, I don't know if you have it from before or Facebook or.
No, I haven't. Yeah, I actually driving too. So, um, you don't mind? Could you put on the chat? I'll copy that and then I'll reach out to you afterward.
Okay, yeah, I'll do that.
Well, Greg, you'll be able to.
Thank you so much.
We have your contact email. He can reach out to you directly.
Thank you.
Awesome. Thank
You're
you.
welcome.
Thank you for coming. Well, we have our next meeting next month. That one will be in person, February 20th. Is the third Tuesday of the
Mhm.
month. If you have any questions before then, any investment opportunities, properties that you come by that you need help underwriting or have questions on, reach out to us. We're here. We're here on social media. We're here. You'll be receiving a thank you for attending message with all of our contact information. So reach out. We're actively looking for investments, underwriting, and helping our folks out. We did share the opportunity regarding GOB Network of apartment investors. If you would like to join that network, we have over 1,700 investors as a part of the network, both nationwide and international, multiple assets, over 90 million. And I think it's over 6,000 doors owned. So reach out to us. We are a wealth of knowledge and a great resource to have. Joining our network is by membership. Right now it's free and it's by invitation only. So if you're interested, see the person that introduced you to this call or invited you to the call, and they can get you all set up. We look forward to seeing you all next month.
Thank you guys
Sounds
for
great.
coming.
Thank you guys.
Thank
You're
you.
welcome. Thanks for coming,
Looking forward to
guys.
see you guys
Bye.
next month.